This is chapter 9, accounts receivables. Not only accounts receivables on the course Principles of Accounting first part. So, what we learned so far? What we learned so far is the company, when the company starts, has to start to generate sales in order to generate revenue. Sales can come from the three sources or three types of businesses that you technically you can possibly have. One is the service, the other one is the merchandising, and the third one is the manufacturing. In all of those three type of businesses, you're chasing sales. And more importantly, you're chasing the sales to be more than expenses. Once you generate sales more than expenses, you can see that on the income statement, which income statement is the first statement, most important statement for the owners of the company, or for the investors of the company, or for the creditors of the company. Can the company generate income? Once we see, oh yes, company can generate income, then we're going to see how much of that income is going to stay in the company and how much is going to be given to the shareholder or for the owner of the company. Shareholders, we're going to talk about next course, which is 1210. Principles account second part, and then you're going to see that there's a corporation that has shareholders. Now, once we see what the net income is, net income usually going to stay in the statement of owner's equity. That's where we can see the net income in form of retained earnings. So all the earnings that are accumulated from the start of the company and retained in the company, is we're going to see it in the statement of retained earnings or in the retained earnings account. Once we do that, then we can see if this company has assets, liability, and equity. Obviously, assets minus liability is going to give you equity, or the amount what we calculate in the statements of owner's equity. So now, once we're generating the sales, we have two options. One is to collect the sales right away from cash. The other one is not to collect or to sell on credit. Today we're going to deal with what we're going to have if we have receivables and how the receivables are reported on the balance sheet. So first, the receivable happen because business or person sells goods or services, or now the goods are merchandising and all the finished goods. That will be depends on the business to another party. So once we sell the goods and services to another party on credit or on accounts, the way we see it on the examples with the scenarios, journal entry, that will create receivables. The other purpose for the receivables is when we lend the money to another person. Each credit transactions will involve two parties, and one will be creditor, the one selling something, or the one who obtained a receivable or the assets, and the debtor, the one who made the purchase, or the one who has to make a payable later. So let's remind ourselves just for a second, what was the whole idea with the accounting? I'm going to plug here one new slide, and I'm going to use this slide to explain to you very, very, very quick. Let's remind ourselves what was the basic accounting equation. Basic accounting equation, if you still remember, that was assets are equal to liability plus equity. Now, what kind of assets we're going to have and what kind of liability, that's part of a little bit later. We're going to go with that one a little bit later. But now let's focus on this accounting equation. Asset equal to liability and equity. So what usually happens in the business is people have an idea when they have an idea, they start their own business. Or start a company, or start sole proprietorship, start any form of the business they want to decide to do. What kind of business they're going to go, that's a different story. Either you're going to provide services, either you're going to sell goods, either you're going to manufacture the goods and sell. The point is that the company, the most important asset of the company, or the most liquid asset of the company, is cash. Why? Because with cash, we can buy it. And we can easily convert cash in one form of asset to another form of asset, which is going to help us to generate sales. Now, if we do not have cash, we have to get the cash from somewhere. Now, the question is, from where are we going to get the cash? And the way I see it from the accounting equations, we have only two options here. Either we have a lenders or creditors. Either we're going to have the investors. There's nothing more, nothing less here in this case. The other option is the investors. In brackets, we can put here the owner of the company. It might be the one who is investing in it. As a part of the investors. So what these people have, these people, now, company, we start in company. We don't have cash. From where are we going to get the cash? We have two options, from the lenders or creditors, or from the investors, or from ourselves. Since the business don't have cash, on the other hand, we have somebody who actually has the cash. It doesn't cooperate, but let me see how I can move from here all the way down to there. So what's interesting on the other side of the equation here, they do have cash. And that's what we're doing. We're trying to get the cash from either from the creditors and lenders or for the investors. Now, when we sell on credit, we're becoming in some way creditor or lender. So basically, we're going to have the asset, which is accounts receivables, and somebody's going to have to pay us that account receivable, which, in the other hand, for the somebody, that will be accounts payable. For us, will be accounts receivable, for them will be accounts payable. So in that case, we'll become lenders or creditors. And then what we do, we're going to try to get the cash. So the receivables, there are three types of receivables. One receivables is the trade receivable. Also known trade receivable, amount of collected from the customers or current assets. Then we're going to have note receivables, which will be the formal receivable, which include a written promise on the specified date, which on that day we're going to get because we're the one who have we lend the money to somebody, and now we have receivables, so somebody has to give us back. We expect to get the principal back plus interest. If it's within 1 year, it's going to be current assets, which is over 1 year, it's going to be long-term assets. And other receivables will be sometimes the company lend money to the employees, or the company has tax refunds or interest receivables. Those are other types of receivables that we may see in the normal operation of the company. Now, once we start selling on credit, or before we start selling on credit, let's see our sales. We start our business we're providing either services or selling merchandise. Some of the clients going to pay cash. The other clients, they may not have cash at the moment of the sales. So that will be our decision what to do with those clients. Shall we give them, provide the service, or give them the goods and wait for them to pay later, or not to give them? Obviously, most of the businesses, they prefer to do the sale and give the opportunity to the client to pay later. That's going to be transferred into accounts receivables. What's the benefits to having accounts receivables or to sell on credit? You can sell to clients. They don't have to pay right away, they can pay later. What's the downside of having accounts receivables? Some of the clients may decide not to pay. So today we're going to discuss what we're going to do if we feel that our clients, which will provide the service or sell the goods on credit or on account, we feel that he's not going to pay. What we're going to do in that case? Obviously, uncollectible amount, which comes from the sales and the client not going to pay, it's going to be operating cost. And it's going to be called bad debt expense. That is when sell on credit, so we give them debt. Bad debt means that debt's never going to be converted into cash. There's no one indicators that tells us, there's nothing, but you may feel that there's a signs that tells you that this client not going to pay. Before we go any further, I have to make sure that you understand something. In accounting, we are conservative. One of the principles of accounting is conservatism. What that means? That means if we feel, there's a slightly chances of something to go wrong, which will be against our interest or company interest, we have to show it as a journal entry on either balance sheet or either income statements. In this case, going to go as a bad debt expense on the income statement and some other account we're going to see just a little bit later on the balance sheet as well. So as soon as we feel that there's something potentially going to harm the company in the negative or going to impact the company in a negative way, we have to make a provision. That's called provision. And we're going to make that journal entry. Opposite, if we feel and if we know and if we sense that something good's going to happen in the company, we're doing nothing until that good thing actually happens. So for the people who gonna want to go further with the accounting and gonna go further with the accounting, this is a very important thing. You need to know, I need you to understand that you know this. Every time when you feel that something bad's gonna happen, which is gonna affect the company in a negative way, you have to make a provision. Record the expense, show on the balance sheet. That will be the liability, either some contra account. We're going to see to that. But if the opposite happens, if you feel that something good is going to happen, there's a low case that's pretty much 100%, you're going to win that case. You're doing nothing until you actually realize the good thing. When you realize the good thing, then you make a journal entry. So that being said, every time when you feel that there's uncollectible amount related to accounts receivables, we're going to show bad debt expense. Again, there's no indicator that account will not be paid, but we have to read the signs. First, the client have 30 days pass from the sales, no payment. 60 days pass after the sales, no payment. 90 days pass after the sales, no payment. 120 days pass after the sales. Most likely, we're going to have problem with this. So that's the first one of the indicators. The client doesn't pay. 120 days, he doesn't pay. Then we're trying to contact the client or the customer, but there's no response. First, the telephone doesn't work, or the telephone that we have on file constantly goes to the voicemail, which voicemail magically is full, and the operator tells you, next time when you connect with the client, with the customer, please let the customer know that his voicemail is full and he has to delete the messages so he can leave the message. Or the other interesting part is you calling there and they say wrong number, or somebody calling or somebody picking the phone and say, no, that's not me, wrong person. That's another indicator that probably you're going to have problem with this client. Somehow you found the phone number, somehow you even found the email for the client. You're sending the client email, the emails bounce back and says the company is under receivership, or the company filed for the bankruptcy, or the company has closed. That's another indicator that we're not going to get paid. The obvious, which is classic example of not being paid, is just you have the company address, you have the company phone number, try to call, nobody's picking the phone. You're going to the address, turned out to be construction site, or there's nothing there. It says third floor, there's not even building. So the customer cannot be located, the building doesn't exist, the address is fake, everything is not the way it should be. Most likely, this one is definitely bad debt expense. What we're going to do? We're going to estimate the amount based on the experience. And then we're going to record the amount by simply matching the bad debt expense with the sales revenue to which bad debt is related to. We're going to match it in the same period. So if the sales is from this week, we're going to do the bad debt expense in this week. Now, since we're not doing the weekly reports, we'll say, so what's the shortest financial report or reporting period for the entity or for the company? That's the shortest period this month. In the very rare cases, you will have idea that within the month of the sale that you're not going to get paid. But the longest period is the 1 year. So now, if the sales are related to 2024, at the end of 2024, you haven't received the money, and you're feeling that the client might not going to pay, then you're going to record the bad debt expense. Bad debt expense is going to be recorded in the account called allowance for doubtful accounts. That allowance for doubtful accounts will be contra account to accounts receivables. Contra account means the companion account with the opposite balance. So simply, if I have to show this on the Excel spreadsheet, it's going to look like this. We're going to have first account for accounts receivables, and then we're going to have a companion account, which looks like accounts receivables, but it's going to have the opposite balance. So if I have to share and show my screen, that's going to look like this. We're going to get one account, which account is accounts receivables. That accounts receivables, as we already know, is a balance sheet account. Normal balance is debit. So if this is our debit and this is our credit, that will be our accounts receivable account, which again has a beginning balance on the debit side. I'm going to copy this now. So again, click here. Beginning balance is going to be on debit side and ending balance going to be on debit side as well. Every time when we sell on credit, that's going to increase the account. And every time when we collect the cash, that's going to decrease the account. Now, allowance for doubtful accounts, it will be contra account, which means to account receivables, they're going to be side by side, but this one's going to be contra to the other. What that means? That means accounts allowance for doubtful accounts going to have normal balance credit. So beginning balance will go on the credit side, ending balance going to be on the credit side. That will be the main difference. And the other thing is, you're never going to see allowance for doubtful account on the balance sheet. Then what we're going to see on the balance sheet? We're going to see on the balance sheet, if we have to prepare the balance sheet statement. Very simple balance sheet. We're going to see that the balance sheet is going to have current assets. And the current assets, we're going to start seeing there's cash, there's net accounts receivable net, and inventory. Now, on the accounts receivable, there will be here probably a note which says net, and there's going to be something like note 2, for example. And under that note 2, when we look at the note, we're going to have accounts receivables, and that will be less allowance for doubtful accounts. And that's going to, once we deduct one after another, it's going to give us accounts receivables net amount. And that's how it's going to be presented on the auditing. It's going to have note in the brackets 2, which will be related to the note which is sitting here, and that's going to be even. Let's make it a professional start 2, and note start 2 will be related to explanation of what exactly is this related to. We're going to have amounts of accounts receivable, less allowance for doubtful accounts for a given net accounts receivables. So if the beginning balance is 0, the accounts receivables during the period is $10,000, and we decide that most likely we're going to have a problem with collecting the cash that is related to these accounts receivables. We can make a provision. Debit bad debt, create allowance for doubtful account for, let's say, for $1,000. And then on the net here, we're going to see that cash, let's say accounts receivable is going to be in this case $9,000. Why would be $9,000? Then we're going to check out the notes, and we're going to find out that the note simply is going to tell us that we're going to have accounts receivables of $10,000, allowance for doubtful account of negative $1,000, and we're going to have net of $9,000. And that's how it's going to be. And that's accounts receivable is going to end up in the balance sheet under the current assets. It's going to show us the balance. That will be very, very simple explanation on that allowance for doubtful accounts. So as we said, accounts receivable is always going to be accounts receivable net amount of actual accounts receivable less allowance for doubtful account. In this case, allowance for doubtful accounts $900. So accounts receivable net will be $9,100. How are we going to estimate? Because remember, we have to estimate this allowance for doubtful account. How are we going to estimate it? How much is uncollectible and how much should be our provision for allowance for doubtful account? We have three methods or three approaches. One is percentage of sales. The other one is percentage of accounts receivables. Third one is aging method. The first one is allowance method. Directly calculate the allowance. Where the second and third will require adjusting entry because the methods calculating the ending balance for the period. Percentage of sales, that comes from the name. It's going to be based on the percentage of the total sales of the company, or actually not total sales, the sales from credits. Because from the total sales of the company, we may have a cash sales, which has been already collected. So we're chasing only the outstanding amount of the sales, which is not collected on the reporting date. Then we come up with the percentage. How are we going to come up with the percentage? That will be percentage based on the industry, based on the previous experience, based on the Statistic Canada, based on your discretion. And we're going to apply that percentage to the net credit sales. This is called income statement approach because it's focused on the amount. It focuses on the amount of the expense. It's going to ignore the current balance of the allowance for doubtful accounts. It's going to ignore the beginning balance and everything. We're just calculating the expense, amount of expense. This one, again, is based on the prior experience of the business or the industry. So let's see how it's going to be. It's going to look like this. Credit sales were $500,000. Bad debt expense at 2%. Now we have to prepare adjusting entries. Let's go to this Excel spreadsheet since I already created. Let's start using it. Finally, change it. So let's paste this as a picture. So now we have a credit sales of 500,000, but that expenses is 2% of the credit sales. So what we're going to do? Account receivables, credit sales, beginning balance. Let's say beginning balance is 0. 500,000 is the credit sales, and we're estimating that 2% of those will be uncollectible. So we have to record the general entry for bad debt. First, let's calculate the 2%. Accounts receivables is again 500,000. Then we're going to have the percentage of the allowance for doubtful account percentage is 2%. And then allowance for doubtful account is going to be some percentage here, 2%. Then allowance for doubtful account as a dollar amount is going to be equal to 500,000 times 2%. We calculate the allowance for doubtful account is $10,000. So we're going to have here credit of $10,000. And we're going to do the general entry, debit bad debt expense. And credit is going to be allowance for doubtful accounts. Now the bad debt expense is going to be, so from those one make it a little bit bigger. If that's our debit. Actually, let's push it a little bit further. Those two. This will be our debit, will be credit. How long if we have to do this? So debit will be $10,000 going to the bad debt expense and $10,000 go to allowance for doubtful accounts. What means to us, we're going to put here $10,000. What's going to happen with the balance sheet presentation? On the balance sheet presentation, before, so watch this, this is important, I want you to understand this. Before to do this journal entry, we're going to have, let me see where I can post the picture. We're going to have accounts receivables 500,000. And here the calculation will be 500,000. Before we do the journal entry for the allowance for doubtful account will be 0 in this case. So the net accounts receivables will be 500,000. After we do this journal entry, we're going to have on the balance sheet, we're going to have the following information. Now we're going to have one more. This. So we're there. We're going to have accounts receivable net of 490,000. Why is that? Because we're going to have accounts receivable for 500,000, allowance for doubtful account with negative 10,000, and that's going to give us net 490,000. What's going to happen in accounts? Again, 10,000 here. In this case, will be again. Let's change those numbers. Yeah, 500,000 negative 10,000, 490,000 pounds. Once we do the generate. So this is before. This is after the generate. In this case, and I don't even need this. This information here we have it. And that's our journal entry in our presentation. So this is the first method, which is percentage of sales. The second method is called percentage of accounts receivables. Now, what's the difference? The difference will be in the second method, we're not going to calculate the expense, we're going to calculate the balance of the allowance for doubtful account. So what that means? That means once we come up with the balance, we have to check what's the beginning balance, if there's a balance from before, and we have to adjust to add credit, most likely, and to match the balance that we just received. So there are two steps here. First, we're going to calculate the target allowance for doubtful account balance by simply multiplying accounts receivable times the percentage that we estimated. And second is to calculate the actual bad debt expense. Let's see the example here. The example will be this company. Assume that the outstanding accounts receivables is $100,000, 5% estimated to be uncollected. The current allowance for doubtful account is $1,000 before any adjustments. Let's see how exactly this is going to work. I'm going to move here, and that will be percentage of accounts receivables here. So our information is, assume that the outstanding account Yes, this and this and this. So what we're gonna do is I'm gonna insert some rows here. Gonna grab this information and gonna move it right. And the same thing with the journal entry. I'm gonna grab this journal entry and I'm gonna move it. Okay, now we have, in this case, accounts receivable. Outstanding accounts receivable is, we don't know how much is part of the sales, and in balance 100,000. And we have to calculate allowance for doubtful accounts. Now with $100,000 is accounts receivables. In this case, I have to change it here to sales. Accounts receivable 100,000. We estimating the 5% are uncollectible, so that means $5,000. We have to do the journal entry. Debit. We're not doing anything actually. Journal entry is not here. Journal entry is after. So let's see where we are. On our accounts, we have outstanding receivables, $100,000. Allowance for doubtful accounts, we have beginning balance of $1,000. Once we calculate this allowance for doubtful accounts, that will become our ending balance here. So once I get this balance, $5,000, that will become my balance, which I have to plug right here. So I have my ending balance through this method. Now I have to make adjustment entry to adjust my current balance from 1,000 to become 5,000. The question is, how can I do that? I'll simply follow the formula. Since this is the contra account to the debit account, which is balance sheet account, then we'll apply the credit. It's going to be credit plus the beginning balance. Beginning balance plus the credit is going to be equal to debit plus the ending balance. Since debit is 0, beginning balance is 1,000, ending balance is 5,000. How much should be my credit? That's the question that we're asking. Once we find out that, then we can do the journal entry. Then I can grab again this journal entry and make the journal entry. But in this case, the journal entry will be to adjust the balance to come from 1,000 down to 5,000. So the amount that I need to plug here should be $4,000. And that $4,000 is going to go now directly in my journal entry. So once I have this arrow, I'm just going to flip it the opposite way and grab this 4,000 to come right here as part of my journal entry. So in that case, the bad debt expense is going to be for $4,000. And the allowance for that account is going to be $4,000. How the balance sheet is going to look before the journal entry, we're going to have here 100,000 accounts receivables. After that, we're going to have accounts receivables equal to 96,000, which will be 100,000 here minus 4,000, or 96,000 allowance for accounts receivable net amount. And that's how we're calculating this method, which is percentage of sales. The last one will be the percentage of the aged accounts receivable. And that will be simply looking at the receivables on the timeline of the time and see which one is the oldest one, which one is the newest one. So that will be estimating the ending balance of allowance for doubtful account again, and the balance sheet approach focusing on the outstanding accounts receivables when they're grouping the accounts receivables based on the length of the time that has been outstanding. Usually you're going to see something like this, which is summary of the accounts receivables. It's called aged or aged accounts receivables. It's going to give you what's the accounts receivables within 1 to 30 days, 31 to 60 days, 61 to 90 days, over 90 days. It might give you sometimes 91 to 120 days, and then over 120 days. Anyway, you're going to have a balance. Once you calculate everything, you will have the total for each of the section of the age accounts receivables. Then you're going to apply some percentage based on the experience, based on how you feel. Most likely over 90s, most likely it will be 100% uncollectible, but you can go with the optimistic to go for it only 90%. So once you do that calculation, you're going to estimate, you're going to calculate how much is the accounts receivables under certain column of the age accounts receivables. You're going to accumulate all the totals that you're getting, and that's going to give you the balance of the allowance for doubtful accounts. As you can see, in our case here, we calculated that the balance is $10,100. What that means to us, that means that we have to make a bigger adjustment than the previous case. So in this case, when we look in the information, we're going to find out that our accounts receivables are actually 10,100. 10,100 is going to be our ending balance. So that means we have to adjust from in this case, our accounts receivables are irrelevant. Percentage. As you can see, in the different columns, we're going to have different percentages. So we have to calculate all the percentages. That will be not applicable in this case. We're just going to calculate all the amounts, and we're going to come up with the $10,100. Once we come up with $10,100, what we have to do is to plug it as an ending balance. Once we plug it at the ending balance, we can make this calculation, which will be equal to this one plus the debits minus the beginning balance. In this case, it's going to be $9,100. So our journal entry should be bad debt expenses for $9,100 and allowance for doubtful account for the same amount of $9,100, since we know that we have to be in balance. What will be the presentation on the balance sheet? We're going to balance sheets for before this journal entry. We're going to have accounts receivables for $100,000. After that, we're going to see accounts receivables of 100,000, allowance for doubtful account minus 10,100. Accounts receivables in this case going to be $89,900 net. And that's how we're going to calculate the allowance for doubtful account and the bad debt expense under the aged method or aged accounts receivable method. Those are the three methods. So now again, the difference is how we calculate the bad debt expense. On the percentage of sales, everything is directly related to sales. We don't know how much is the accounts receivables here, so that will be wrong information here. We shouldn't be doing this way. But we can easily, let's pretend this continuation one case to another. So $100,000. And we calculated that accounts receivable here will be $100,000. And here we're going to have $100,000 minus 10,000, which doesn't change the previous one. So we got 490,000 or 90,000. If we have to be accurate. Now, the first method again give you the amount of the bad debt expense directly. Second method calculates the ending balance of allowance for doubtful account, so that require adjustment, which you have to calculate the amount of the adjustment. And the third method is again going to give you the ending balance of the account of the allowance for doubtful account at the end of the period. So we have to make a manual adjustment for the journal entry, which is going to bring the beginning balance into the current estimated ending balance, which is 10,100, and that's going to trigger the journal entry for the bad debt expense and allowance for doubtful account. As you can see, the second and third method are absolutely identical. The first one is the one that is easiest because they require only one calculation. For that reason, I'm not going to test you on the first one on the final exam. Only the last two methods going to be tested on the final exam. It's more challenging, more interesting, and require more paying attention to details. So now again, accounts receivable H method. Once we do it, we're going to have amount, which amount we have to credit to allowance to the existing amount of allowance for doubtful account in order to achieve the balance which we calculated under the H method. And once we do the accounts, we're going to see accounts receivable is $100,000. Allowance for doubtful accounts going to have that adjustment. Net accounts receivable is going to be $89,900. Comparison between the two methods. Again, the first method, income approach, give you directly the bad debt expense. With the second and third approach, they give you the ending balance for the allowance for doubtful account that require adjustments to make in order to come up with the amount of the bad debt expense. What's going to happen if once we record the bad debt expense and we increase the allowance for doubtful account, what's going to happen if the client actually become uncollectible? So by saying allowance for doubtful account means that we have a doubt that we're going to collect the amount, but we're not certain yet that we're not going to collect. In this case here, we are absolutely certain that the client's not going to pay. And this scenario, as you can see, we're assuming that on March 31st, the customer, we identify two customers which may not pay the work. So what we have to do, we have to reduce their accounts receivables, bring them to zero. Since we're not paying, we write it off. And for the same amount, we have to reduce allowance for doubtful accounts. We cannot go back to allowance for the bad debt expense because that bad expense already been calculated and accumulated in the allowance for doubtful account. So for that reason, when we're writing off, we're not adding a new bad debt expense, rather than we start reducing the allowance for doubtful accounts. Because we already participated and anticipating that those two clients not going to pay. What's going to happen if we recover? If the client comes later, first there was indication that he's not going to pay. Later on, after 1 year, year and a half, he came up with his senses and he said, you know what? I'm going to pay you guys. you've been loyal to me, so I want to pay. So in that case, in order to receive the payment, since you will already write off the accounts receivables, we have to bring the accounts receivables back by reversing the entry with which we erasing the accounts receivables, which is debit allowance for doubtful account, create accounts receivables. Now we have to flip it, and we have to debit accounts receivables, create allowance for doubtful account. So now we have accounts receivables sitting and waiting, and then we're going to have debit cash credit accounts receivables to clear that entry and to show that client has paid his balance. Can we, instead of going to allowance for doubtful account, can we directly write off? Yes, we can. But technically we can, but in reality nobody's doing it. Why? Because it's not acceptable under general accepted accounting principles. Why? Because we're not creating any allowance account, and that's doesn't make financial statements too useful. Usually people, they want to know out of the money that you have collectible, how much is uncollectible, or you think it's uncollectible, or you think it's going to be slow collections. That will be only acceptable when the uncollected amount is very, very, very low. Then you might have a direct collectible method. That means if you're planning to not collect $5 or $10 when the average annual sales are $4 million, yes, you can write off that. Any other circumstances? You're going to the allowance for doubtful account. Direct method is going to be directly bad debt expense create accounts receivables. Exercising control over the accounts receivables, that will be the situation where the person who received the checks is not the person who doing the general entry. So we can use the credit department. That's a very good idea. However, if it's only one owner without help from everyone, it will be very, very, very hard to create a credit department in the company, which credit department is expected to deal with the credit application to the customers and all those things. Now, if you're a small grocery store or coffee shop, and the client asks you, I'm working for the office upstairs. I want to buy this and this and this coffee. Right now, I don't have my wallet with me. Is it okay to order the coffee, pick up the coffee, and tomorrow I'm going to come? Anyway, I'm new here. I'm going to purchase, they're going to use me for coffee purposes. So can I come here and pay you for the 2 days order as well tomorrow? Now you have to make a decision. Are you going to accept it or not? Doesn't sound or looks like a credible customer or not. It's going to be your discretion. If you feel that the customer is credible, then you can give him the goods on credit. Now there's another here. If the company is big, then you're going to have this credit department. And credit department employees should never have access to the cash collection. So that means whatever they chasing from the client, they don't see, and they don't only on the report they can see is that allowance for doubtful account or bad debt actually collected. How are we going to account for the credit card, debit card, and online sales? Now, in order to speed up the sales, that's the objective of the company, to increase the sales, revenue, to speed up the sales, customers to have more convenience way to pay. We're gonna start accepting a credit card payments. Once accepting the credit card payment, the downside is that you're never going to see the exact money that the client actually sent you. Why? Because some of the money is going to go to cover the charges for the credit card sales. So you may sell for $1,000, but you're not going to see $1,000. More likely you're going to receive $9,200, $300. And when you ask the student what's happened here, oh, I'm so sorry. There's a there's a problem, so that's why you have to deduct more. So now on the credit card, what we can do on the credit card is you can charge the client more. How much more you can charge the client? You can charge the client. Some company now start collecting the surcharges, or how they call it is processing fee. So if the client comes and say, I want to pay with the credit card, and you say, okay, how much is the amount? You checking the amount you have to collect from the client. The sales is for $100,000, and you want to collect exactly $100,000 after the visa fee. So that means you have to anticipate the visa fee, charge the client before upfront those fees, so you can get exactly the $100,000. So how this gonna work? Now, if you don't charge in this, then once you process the visa payment, if the sales are for $100 and the client pays with Visa, which Visa charge you 2%, then the cash that you're gonna see will be less than 2%, not 100, but less than 2%. So the cash that you're gonna see is gonna be $98. It's gonna be deposited to your bank account. $100 is your sales, so you have a discrepancy of $2, which will go to the credit card discount expenses. And that's where we're gonna leave it. For the non-bank credit cards example will be some other institution, dining club cards, or some other institution. They can also provide a credit card, which is different than Visa, MasterCard, or American Express card. So in that case, it's the same scenario going to apply. And you're going to credit the actual sales. You're going to debit the actual cash that you're receiving, and the difference is going to go to the credit card discount expenses. Paying with debit card. If the client wants to pay with a debit card, most likely you're going to accept the debit card because the debit card charges are way, way less than the credit card. So in this case, same rule going to apply. First, you're going to record the sales for the credit sales revenue for the amount of the sales. Then you're going to see how much cash you're receiving from that sales actually is deposited in your bank account. So that will be debit cash. And the difference is going to go with the debit card service fee account. That will be expense account. For the online payment, you may have the PayPal, you can may have Apple Pay, you may have Apple Pay is related to Square. Square, when you put the Square, that's that's most likely related on the Apple system, which Square is similar to the credit card charges. The other form of the payment can be e-transfer. You're familiar with e-transfer. The other one can be recurring fund transfer. Those will be accounted the same way as a bank account for the credit card or debit card. The sales will be the sales amount that we're selling. The cash will be the amount which is deposited to our bank account, or the actual cash that we see. And the difference is going to go to the, in this case, PayPal service fee, or Apple Pay service fee, or e-transfer. For the e-transfer, there's no service fee. That's the C-transfer is without service fee. So sometimes if you want a certain amount to be paid faster, you can use e-transfer. Or again, on e-transfer, there's no service fee. If it's within the amount, and that amount vary from one bank institution to bank institution. For example, the TD daily minimum is $3,000, and the weekly daily maximum is $3,000, and they also have a weekly maximum of $10,000, which means that you can e-transfer 3 days in a row 3,000. That's going to be 9,000, and the fourth day you can e-transfer only 1,000. and that will be cumulative 10,000. However, if you want that limit to be increased, you can easily call the bank, talk to somebody from the bank, and they're going to increase that credit limit for you, or payment limit for you in that case. In different bank institutions, they encourage you to go to the application, mobile application on cell phone, and the limits there per day can be significantly higher than if you're doing the online banking through the PC. Now, the company that accept cryptocurrencies such as Bitcoin, they're going to have no transaction fee when the sales is made. Factoring and pledging receivables. Factoring receivables, that will be selling receivables to the finance company or bank. So that means that whatever amounts stay as accounts receivables, we can sell it to the third party. Once we sell it to the third party, we're going to get some cash immediately. And after that, that third party is going to start collecting our accounts receivables. The amount that they collect, that will has nothing to do with us anymore. Usually collection companies, they charging between more like 60% of the accounts receivable. So imagine if you cannot collect $100,000, if you sell it to a company which doing collections, they're going to pay you $40,000, and the $60,000 they keep it for themselves. And some of those companies even tells you, okay, I'm going to try to collect the money, and for every dollar that they collect, I'm going to give you 40 cents. And that's a little bit too much if you ask me. So for that reason, you better try to collect, if you have accounts receivables, better try to collect those accounts receivables by yourself. That's going to save you some money. Pledging is when we're using the accounts receivables as collateral or security to get on the loan from the bank. For example, some banks, they're going to give you the credit or line of credit, which is attached to your balance of the accounts receivables. But if the accounts receivables balance drop to under a certain amount, then that credit, that loan is due. So that's another thing that the banks can put in. Note receivables. On the note receivables, I'm not going to spend too much time. Note receivables is a document which entitle you to payment of the principal and interest. It can happen when you're selling something and the person don't have cash, but he wants to give you some certainty that he's going to pay. He may issue, and you may receive a note payable, which again is going to entitle you to the principal or the amount of the sales plus additional interest for the time that your cash, in this case, is used from the other party. Again, can happen with the sales and can happen with the settlement of accounts receivable. So accounts receivable option for those is to be converted into the note receivables. Note receivable is going to look like this. You're going to spend more time on the note receivables, but on the other side, when you second course of accounting 12, then the teacher is going to talk about note payables in that case. It's a kind of promissory note which has a specified date on which date is issued, which date has to be settled. What is the principal amount, what's the interest amount, and how much is how the interest is accumulated and everything. Well, now identifying the maturity date on the bonds, and then maturity date will be the date on which the bond expires and become due. Counting the date. Now counting the date that the teacher is gonna go with you 12 times. He's gonna explain to you. I don't want to mess with your head right now. How you're gonna count the days. And computing the simple interest is you're going to have the amount outstanding times the percentage, having in mind that the interest in Canada is always and always disclosed on the annual base. Even on the credit card, when you see when they're saying the 29.99, that's an annual percentage. It's not per week. It's not per day. Not receivable, not receivable. And again, on those accrued interest and everything like that, I'm going to leave for the 1210 teacher to explain to you. What's going to happen if the not receivable is not collectible or dishonored? Then we're going to become if the accounts receivables is paid with the then the not receivable is going to be written off as a credit on this side. The revenue will be credited, and then the not receivable is going to convert into the accounts receivable or into cash when the not receivable is paid. Once the not receivable is paid, we're going to close the not receivables by creating not receivables. We're going to have the interest revenue for the amount of the interest received. Let's do some quickly some discussion about the analysis of the accounts receivables, more specifically analysis of the asset ratio. For the asset ratio, before we go to the ratio and asset ratio, let me explain a little bit about the ratios. The liquidity ratio is the one that is important. That shows you how liquid the company is in terms of does the company has ability to pay the current liabilities. From where this is going to come? That's going to come from the fact that the company, again, from the basic accounting equation, we're going to have assets which are equal to liability plus equity. And then we're going to know that under the assets, we're going to have two types of assets. One of the assets is current asset, where the other asset is long-term asset or non-current asset. So we can have a current asset. And then we're going to have current liability. On the assets also, we're going to have long-term assets and long-term liability. So what we're going to see, we're going to match the long-term assets with the current assets with the current liability first. And we're going to calculate the current ratio. And the current ratio is going to be simple current assets divided by current liability. Now, if the current ratio become 1, that means only one thing, the current assets are equal to the current liability. If you drop below 1, that means the current liability become more than the current assets. If it's higher than 1, that means current assets are more than the current liability. What do you want this current ratio to be? As high as possible. Now let's go and take a look at the quick ratio or acid test ratio. The acid test ratio also is going to include some of the current assets, but not all the current assets. So to compare to the current ratio, in this acid ratio, quick ratio, inventory and prepaid expenses will be eliminated from as part of the current assets, and we're going to have only the assets which are easily convertible to cash. Inventory is not easily convertible to cash because the option for the inventory is that it might become accounts receivables, and accounts receivables is not cash. So for that reason, we're going to have only cash, short-term investments, and net current receivables divided by the total current liability. That's how we're going to calculate it. Now, the next calculation will be days sales in the receivables and accounts receivables turnover. I'm going to spend more on accounts receivable turnover because that's an interesting number. Accounts receivable turnover, you're gonna calculate it when you get the net sales on credit, because if the sales are on not on credit, the sales are on cash, then there's nothing to collect. So accounts receivable, there's no accounts receivable turnover because you collect it right away. Now the net credit sales divided by average net accounts receivables. How are we going to get the average? That will be simple average. That means beginning balance plus the ending balance divided by 2. How we can interpret this ratio? This ratio is very simple for the interpretation. Once we get the net accounts receivable turnover, then the next step will be accounts receivable turnover. Again, will be equal to turnover. It's going to be equal to the credit sales divided by average accounts receivable. Simple average. That's going to give you a number. Let's pretend that the number is 1. For some reason, we come up with accounts receivable number is equal to 1. Then we have to see what's the accounts receivable days that stay in accounts receivables. Days in accounts receivables. And that will be equal to the 365 divided by accounts receivables turnover. So if my accounts receivable is turnover, that means day in accounts receivable is going to be 365 divided by 1. So that means it's going to be 365. That means it takes me 365 days to collect accounts receivable. Which means once you do the sale, you're going to see the cash after 1 year. Is that a good ratio turnover? Definitely is not. So where do you want the accounts receivable turnover to be? As high as possible. So if you want it to be the day to collect the accounts receivables to be 1 day, that means your turnover should be 365. If your turnover is 365, yeah, if you have as a denominator 365, then you're collecting on the same day, which is related to cash business. So again, you want the accounts receivables turnover as fast as possible. So if you have the credit term with the client between 15 and 30 days, you want this days to collect accounts receivable to be around 20, 25, maximum 30 days, no more than that. Impact on the International Financial Reporting Standards and Accounting Standard for the Private Enterprises, having in mind that this course is in the Accounting Standard for the Private Enterprises. Well, for those of you who continue with the intermediate accounting, when they start talking about the International Financial Reporting Standards, then you're going to see the difference between one and another. Right now, there's not much to tell you about that. And appendix, we're not going to spend time on appendix. So again, what is important from this chapter, you to understand and to practice is the three methods of calculating the allowance for doubtful accounts. The first method is percentage of sales, second method percentage of accounts receivables, and third one is the aging accounts receivables. The percentage of sales directly gives you the bad debt expense, when the other two methods give you the ending balance of the allowance for doubtful account, and then you have to work out to get the adjustment or bad debt expense. Having in mind that the bad debt expense is recorded only as a debit bad debt expense, credit accounts receivable. And that's the most important of this chapter. Yes, the current ratio, quick ratio, and receivables turnover and days in the accounts receivables is also important. But that's it for this chapter. As I told you, that's very light chapter, very enjoyable short chapter. Okay, question that I have for you, it's gonna look like this. So this demonstration problem, which this company here. Now the first two parts are related to the note receivables. Again, I'm not going to discuss the note receivables. You have it as an example, but the note receivable is not going to be on the final exam. So we're going to skip note receivables, and we're going to move to the letter C for this on this question, and we're going to focus only on letter C, which is related to the accounts receivables. So that this company estimated the bad debt will be 3.5% of the net credit sales. So that will be bad debt will be 3.5. It's going to be, let's put it somewhere, 3.5%. That's how much they estimated of the net credit sales. So that will be simple. So from this method, we're going to directly calculate the amount of the bad debt expense. So what we have to do now, we have to calculate the net credit sales. During the year, we have total sales of total sales for us are 6,200,000. When I convert this to numbers with the decimals. Then we're going to have total sales of that much. Then we're going to have 35% cash. So we're going to eliminate the cash sales less cash sales, which are 35% of the sales. And 35, and in the bracket, we're going to put that will be time 35%, and the bracket is going to be negative. So 2,170,000 is the cash sales. So in that case, we're going to have that amount left. Then we're going to have allowance for the year, 120,000, which are all related to credit sales. So that's once we eliminate the cash sales, we're going to see the credit sales. Credit sales, and then we're going to deduct less allowance, sales return and allowance. In that case, the sales return allowance are negative of 128,000, which is all related to the credit sales. Accounts receivables in the accounts receivables in amount 130 was identified as an uncollectible written off during the 2014. Calculate the adjusted balance in the allowance for doubtful accounts at December 31st, assuming that credit balance on January 21, $160,000. Okay, so far, what we can do is we can calculate how much would be the estimated bad debt for this company based on the net credit sales. So we come up with the credit sales, and we're going to deduct the sales return allowances. And once we do that, we're going to get the net credit sales. The net credit sales, we're going to apply to 3.5%. That's going to be equal to this one plus that one. We're going to apply the 3.5 in the bad debt expense. In this case, it's going to be equal to this amount times 3.5% or $136,570. Once we have this amount, that the journal entry here will be debit bad debt expense for $136,570, and credit is going to go for allowance for doubtful accounts with the same amount. There's nothing even here for the same amount. So we have our journal entry that we record the bad debt expense. So now what we have to do is to chase what's happened with the allowance for doubtful account. Allowance for doubtful account, we can open the T account. Try to find where we can open it. We can open it right here. And I'm gonna make this one bigger. No, actually not that bigger. Only the middle two columns are a bit bigger. And we're gonna eliminate some of those. So we can have all the information in one place. And that will be allowance for the account. We're gonna have debit on the left side and credit on the right side. That will be our middle part here. Bottom the account and getting the ending balance at the end, and that will be the beginning balance at the top. So our beginning balance in this case, it's going to be based on the question, is going to say that calculate adjusting balance, assuming that credit balance on January 1st was 160,000. 160,000 was the credit balance. Then during the year, at the end of the year, we have the sales, and we calculate the bad debt expense. So we have the credit allowance doubtful account, $136,570 coming in. And they say that they write off accounts receivables amount which is identified uncollectible written off during the year is 113. That will be the amount that is coming from out of the doubtful account. Because once we write off that, the journal entry for this write-off is going to be debit allowance for doubtful accounts, credit accounts receivables for the amount of 130,000. So in that case, we have to debit the allowance for doubtful accounts for 130,000. And that's going to give us the ending balance, going to be 160 plus 136,570 minus 130, and our balance going to be $166,570. And that's how we're solving this type of questions. So now let me see if I can bring another question for you. Question which will be related to what we're doing here. And this question is good. Let me grab it and I'm going to show it to you. Another question which will be related to accounts receivables, but in this case, we'll have to calculate only the account. It's going to deal only and only with accounts receivables and nothing else. And we have to prepare the journal entry under all the three methods of for bad debt, the calculation of the bad debt expense. So we're going to keep going this question. We're going to label it question 1, which in fact, from the set of questions that we have on Blackboard, this is the question class 10, question 4. Now we're going to do the question 3. And for this question, I'm going to post the information. This is the information in this case. So what we have this chart, which gives us the total accounts receivables for the period and the age amount for the accounts receivables. During this company had outstanding accounts receivable 450, as we can see, not due yet 230, 1 to 30, 57, 31 to 60, 22,000, 61 to 90, 26, and over 90, 15,000. During the 2014, the company had sales. So let's pull the information about the sales. Company has sales of I'm gonna copy this, or just not gonna copy, just gonna format it. And I'm gonna put this format here. The sales for this company is 3,720,000, of which 38,000 was cash sales. So cash sales are, so that amount less cash sales, which cash sales are in this case 38,000, is going to give us the credit sales. And credit sales is going to be equal to the total sales minus the cash sales. That's our credit sales. Allowance for doubtful account has unadjusted debit balance, in this case, $3,050. Now prepare adjusting entry to estimate uncollectible amount on December 31st under each of the following independent assumptions, showing the resulting balance sheet presentation for the accounts receivables. So we have to prepare something universal, which we can apply to all three cases. The presentation, first one is the bad debt is estimated to be 0.6% of the credit sales. So we have the credit sales. Now we have to estimate 0.6%. Second one is the bad debt expense estimated to be 4% of the outstanding accounts receivables, which is 450,000. And the bad debt expenses are based on the aging analysis, part of the requirement information provided schedule 4. So that's what we have to do here. 1, 2, 3 things. So let's go with the first one. First one will be, we're going to use the percentage of credit sales. We already know that our credit sales are for the amount of $3,682,000. So what we have to do, we have to calculate the percentage. And the percentage here is the bad debt percentage. And that bad debt percentage is estimated to be 0.6%. So the bad debt expense in this case is going to be equal to trade sales times 0.6% or 22,092. What we're going to do in this case, we're going to do the journal entry to record the bad debt expense. And we're going to have here debit bad debt expense, credit allowance for doubtful accounts for the amount of, get this one first, and leave some space here. And here we're going to have debit and our debit here is going to be for the amount of the bad debt expense we calculated, and credit is going to be for the same amount. So we have our journal entry, as you can see. Now what we have to do, the next thing is to do some calculations here. First, let's start with the allowance for doubtful accounts. Let's see what we can find with that account. In that account, as we can see from our requirements, the account magically has a debit balance, doesn't have a credit balance, which is okay. Allowance for doubtful account can be with a debit balance, nothing scary with that. That will be our debit, on the other side is going to be credit. So the allowance for doubtful account can start with the debit balance, unadjusted debit balance of 3,050 on the debit side on this case. Again, nothing scary, it's totally okay. This account we have a debit balance. Remember, though, it has to finish with credit balance. Whatever starting point is, means that it has to finish with the credit balance, so the ending balance is going to be, it probably is going to end up with credit, but we're going to see where it's going to be. There is nothing during the period. We're not writing off anything. As you can see, we're not writing, there's no journal entry under this account on the debit side. The only journal entry here is the one that is related to the bad debt expense at the end, which is here we have a credit for 2292. So in that case, the ending balance is going to be equal to the debit minus, in this case, credit. So we're going to end up, no, the opposite is going to be the total credit minus the debit. is going to be end up with $19,042. That will be the ending balance for the allowance for doubtful accounts. What will be the presentation on the balance sheet? We're going to have accounts receivables, and our accounts receivables is going to be $450,000. And then we're going to have less allowance for doubtful accounts, which is in this case negative of $19,042. So the net accounts receivables here is going to be the difference between those two. Accounts receivables net will be for the oops, sorry, my mistake here. It's gonna be those two. 439.58. That will be under the first method, which is percentage of credit sales. So now let's see what will be the second method. For the second method, I'm gonna copy this. I'm gonna move this one a little bit closer, like this. And for the second one, I can copy all this information because I'm going to use it, obviously. And I'm going to push it down here. Now, what we're going to do in this case, we're going to have a bad debt is estimated to be 4% of the outstanding accounts receivables. So I can partially use this calculation, but I have to change it a little bit. Now, instead of sales, I don't need sales anymore. I'm going to go with accounts receivables on. All this information because that's irrelevant at this point. Accounts receivables, as we can see from the case, is 450,000. One more zero in it. The percentage of the bad debt is estimated to be 4%. So in this case, I'm going to have 450,000 times 4%, and that's going to give me 18,000 bad debt expense. So on the second one here too, going to have percentage of accounts receivables. Now the tricky part here is this 18,000 bad debt expense will be not going to be by ending bad debt expense, it's going to be the ending balance of the allowance for the four accounts. That will be the tricky part. Whatever we calculate in here, it's going to transfer to the ending balance of the allowance for the four accounts. So that's 18 automatically is going to become here 18 ending balance of 18,000. So now the question is, what will be amount that we have to put as a credit so we can bring 3,050 debit balance up to 18,000 credit balance. Obviously, that will be calculation between those two amounts. So if I credit allowance for doubtful account with 21,050, that's going to bring the balance to 18,000 on the credit side. So my allowance for doubtful account has to be credited with 2150, which is going to be my bad debt expense 2150. And presentation on the balance sheet is going to be in the balance sheet 450 accounts receivables, and that's going to be equal to minus allowance for doubtful account ending balance 18,000. So my net accounts receivable is going to be 430 2,000. So if I'm using the first method, my accounts receivables will be 430. If I'm using the second, it's going to be 432. Now let's see where will be our accounts receivables, net accounts receivables, if we're using the last method, which is the aging method. Now for the aging methods, I'm still going to use this part here. For the aging method, again, on the aging method, still we're going to calculate the ending balance of allowance for doubtful accounts. But now we have to do a little bit more complex calculation, which will involve, if I push all those cells down, now I'm going to have my accounts receivables, even though that's irrelevant, but now we're going to go with the different sections. In the first section, I have 230 accounts receivables, which are current. I'm going to record it as a current. And for the current, I have to apply 1%. And the amount of that is 230,000. Second, I'm going to have accounts receivables, which is between 1 and 30 days. Percentage for that one is 4%, 157. 4% and 157, 153,000. Let's put the percentage here, 4%. Then we're going to have the next one is 31 to 60 days, 8%, and the amount is 22. So 8%, and the amount is 22,000. And that will be accounts receivable between 31 to 60 days. Then we're going to have accounts receivable 61 to 90 days. For that, we apply 25%, and the amount is 26,000. 25%, and the amount is 26,000. And the last is over 90 days, 60% over 15,000. That would be 60%, and the amount outstanding is 15,150. And that's going to be accounts receivables over 90 days. So once we calculate everything, that should give us accounts receivables 450,000. Yes, we are correct. So this accounts receivables beginning matching the link. Accounts receivable. So now let's see what will be this percentage is irrelevant now. What will be the ending balance for our allowance for doubtful account in this case? So we're going to start calculating this column times 1%. That's going to give us 2,300. Next column is going to give us another number, another number, another number. Once I calculate all the numbers, it's going to give me the ending balance for the allowance for doubtful accounts. So that will be my ending balance, 25,840. So the 25,840 will be my ending balance for allowance for doubtful accounts. I already have beginning balance 3,050. Then I have to make adjustment or add credit for 28,890. That will be my journal entry here on this method. That will be number 3, percentage of the aged accounts receivables, and we can pull it in different color, which will be this color here. So in that case, my accounts receivable will be 424,160. So as you can see, based on the different methods, we're going to have a different accounts receivables, net accounts receivable sitting on the balance sheet, Also, allowance for doubtful accounts going to have a different balance. And the bad debt expense is going to be different. The highest bad debt expense, as you can see, is under the H method. The lowest bad debt expense is under the percentage of accounts receivables. And that's how we're solving this type of questions. Again, remember, when you have percentage of accounts receivables or H accounts receivables, whatever you calculate as a calculation for the provision, that will be the ending balance for the last doubtful accounts. Then you have to plug that balance and work out to find out what will be the credit for the allowance for doubtful account, and that will automatically will be the debit to the bad debt expense. So you're doing two calculations. First for the allowance, first for the adjustment for the ending balance, calculating the ending balance, and then to find out the adjustment as a journal entry, which you have to do to bring the current balance to the ending balance that you just calculated. That will be the only tricky part for this type of questions. Questions?